created by MindSticks Foundation Trust.
Welcome, students, to today's Explainer. Let's quickly run through our agenda. We'll be looking at the features of GST, how input tax credit works, some smart ways to invest your money, the absolute basics of the stock market, and finally, how to calculate your actual investment returns.
All right, Section 1, Features of GST.
Now, think of GST, or Goods and Services Tax, as a massive tree branching out. Under our dual model here in India, when a trade happens within the very same state, let's say within Maharashtra, an equal tax is collected by both the central government, which we call CGST, and the state government, known as SGST. Now, if you are in a union territory, that simply becomes UTGST. And what about trading across state borders? Well, for interstate trading, the central government steps in and levies integrated GST, or IGST.
So why did we even switch to this system? Basically, it's just much more efficient. GST actually subsumes or swallows up a whole bunch of older indirect taxes into one single system. And the biggest one? It completely eradicates the cascading effect of tax on tax, which really helps in keeping everyday prices in check. Plus, it brings much-needed transparency, boosts our Make in India project by making our goods competitive globally, and it's entirely technology-driven for super-fast decisions.
Moving on to Section 2, Input Tax Credit Explained. Okay, let's look at a practical example of how businesses actually claim back the taxes they've already paid. Meet Trader M. He is based in Maharashtra. Now, he bought scooter parts from Punjab for 20,000 rupees. Since this is interstate trade, he paid an IGST of 5,600 rupees upfront. He then turns around and sells these exact same parts locally within Maharashtra for 25,000 rupees. On this sale, he collects 7,000 rupees in total GST, which is split right down the middle, 3,500 for CGST and 3,500 for SGST. So, the big question is, how does Trader M utilize that 5,600 rupees he already paid to the government? We have a golden rule for claiming this input tax credit. Step 1, you always pay off your IGST liability first. But since he sold locally this time, his IGST liability is simply 0. Step 2, use the credit to pay off CGST. He owes 3,500, so he deducts that from his credit, bringing his CGST payable down to 0. Step 3, utilize whatever balance is left towards the SGST. He has 2,100 rupees of credit remaining, so subtracting that from the 3,500 he owes means our Trader M only has to pay 1,400 rupees right out of his own pocket for SGST. It's a brilliant system, isn't it?
Let's shift gears, Section 3, Smart Ways to Invest.
Now, I want to ask you directly, what are the best ways to actually grow your hard-earned savings? Just stuffing cash in a piggy bank or a locker at home is not going to secure your financial future. You really have to put your money to work. And this is precisely where diversification comes into play. Just like you maintain your physical health by eating a balanced diet, you need a healthy, balanced habit of investing. Sure, you could put your money into immovable property or gold jewelry, but today, modern financial instruments are just so much more accessible. We are talking about fixed deposits, mutual funds, insurance policies, and of course, systematic investment plans, or SIPs. Any smart financial advisor will give you this one crucial piece of advice. Never ever put all your eggs in one basket.
Section 4, The Stock Market Basics. Let's demystify one of the most talked about ways to invest. The stock market. To establish any large company, you need capital, and this massive sum of money is divided into very small, perfectly equal parts. We define a share as the absolute smallest unit of a company's capital. So if you go ahead and buy a share, you officially become a shareholder. That means you literally own a tiny proportional fraction of that entire limited company. Now, if you want to be a smart investor, it is absolutely essential that you understand the difference between these two terms. First is face value, or FV. This is the nominal, fixed value printed permanently on the company's official share certificate, let's say 10 rupees or maybe 100 rupees. On the other hand, we have market value, or MV. This is the live, breathing, constantly fluctuating price at which those shares are actually being bought and sold in the stock market right now. If a company is doing great, demand shoots up, and naturally that market value goes up too.
So how exactly do these two numbers interact out there in the real world? Well, if the market value is higher than the face value, we say the share is trading at a premium. For instance, it's printed as 10 rupees but people are buying it for 15. Now, if the market value is exactly equal to the face value, it is trading at par. But what if a company is struggling? If that live price drops below the printed value, say it's trading at 7 rupees against a face value of 10, then the share is trading at a discount.
You might be wondering, where does all this exciting trading even happen? Here in India, it's primarily on two major exchanges. First, the BSE, or Bombay Stock Exchange, which proudly holds the title of the oldest stock exchange in all of Asia. Then we have the NSE, or National Stock Exchange, which happens to be India's largest. And to quickly check the pulse of the market, we look at indices. The Sensex is the main barometer for the BSE. It tracks 30 highly secure, financially sound companies. The Nifty, meanwhile, tracks the top 50 companies over on the NSE.
And finally, Section 5, Calculating Investment Returns. At the end of the day, we need to know the true profitability of our investments. When a company has a great year and makes a solid profit, it often shares a portion of that profit with you, the shareholder. We call this a dividend. Now, please pay close attention to this golden rule. No matter how high or low the market value gets, the dividend is always calculated on the face value of the share, never, ever the market value. I want to repeat that because it is so incredibly important. You must calculate your dividend percentage purely on the printed face value. Let's actually step through the math together to find the true rate of return, or ROR. We'll use a student named Shriyash's investment as our example. Step 1. Shriyash purchased a share that has a face value of 100 rupees, but he bought it at a market value of 120 rupees. Step 2. The company declares a very nice 15% dividend. Applying our golden rule, 15% of that 100 rupee face value gives him an income of 15 rupees. Step 3. To find out his actual return on what he spent, we divide that 15 rupee income by his actual sum invested, which is the market value of 120. Step 4. Simply multiply that fraction by 100 to get our percentage.
When we do the math, 15 divided by 120 and then multiplied by 100, we get exactly 12.5%. And that right there is the absolute beauty of structured financial mathematics. Even though the company announced a 15% dividend because Shriyash bought his share at a premium price of 120, his actual true rate of return is 12.5%.
We have covered quite a bit of ground in today's explainer, right from the logical flow of input tax credits down to the exact formulas for calculating your stock market returns. So now that you know the underlying math, I want to leave you with a challenge. How will you apply these concepts to strategically diversify and protect your own financial health? It is never too early to start planning. Use this knowledge wisely, and thank you for joining me today.